What's been happening in the market? And more importantly, what does that mean for you? Welcome to LVZ Market Minutes, the quick and refined update designed for savvy investors who value clarity over clamor. Our team breaks down the trends, movers, and the headlines that matter so you can stay informed and cut through the noise. Let's dive in. Past performance does not determine future results. Securities offered through Harbour Investments, Inc., member FINRA SIPC. Investment advisory services offered through LVZ Inc. LVZ Inc. is a federally registered investment advisor.
We're sitting down May 29, almost the end of the month, with Joey Ott, a member of our portfolio team here at LVZ. And there's been a lot of headlines this month. We'll dig into those for our investors. One of the big ones that came out this month, and this is after we got off the big roller coaster from April, was Moody's headline that downgraded ratings from their AAA standard. Joey, do you want to talk about that big headline and did it matter to clients? Tell me a little bit about what that means for our investors.
On the large scale, it's a big headline as far as practical application and how the market responded and how investors are changing things. It's somewhat been a non-event. It was the third and final credit rating agency to drop the U.S. from a AAA rating. So it's come as at no surprise. We know that there's a lot of debt. We know that there's high interest rates, which makes the debt hard to manage. This isn't a surprise, and there hasn't been a notable outflow of funds from U.S. Treasuries. The rates have been pretty standard. The 10 years right about where it was a year ago, despite headlines and stuff causing things to change. It really hasn't had a large effect on the market. I'd say the market paid attention to it for maybe 30 minutes and then moved on to the next headline. It's worth knowing, but it's not something that a client needs to look at their portfolio and think they need to change anything because Moody's changed their outlook.
Right, and there were a lot of headlines this month, a lot of big headlines that can distract you from what's actually important. The ongoing headline since the beginning of the year that we seem to endlessly talk about are tariffs, and there's still more headlines about it. There's so much noise around it, and the market has just been responding so drastically sometimes from a consumer sentiment point. Talk us through the latest on tariffs. Tell us a little bit more about that.
Last Friday was when Trump talked about how he was going to put this big tariff on the EU because they weren't negotiating well enough, and he was mad at them. And then by Tuesday, when the market opened up again, he tracked that back. The market hadn't even been opened from headline to headline between Friday to Tuesday. So there's so much that's happening, so many headlines. The newest one is the Court of International Trade. They were working on a lawsuit that were filed by some smaller companies, businesses out of New York. And so in the end, what they've done as their step is they struck down some of the tariffs, saying that the state of emergency that allowed Trump to have full power didn't meet the law's definition of an extraordinary threat. So the next step there is the Trump administration has filed a notice that they're going to appeal that ruling. Ultimately, the final say is probably going to come down to the Supreme Court. So we're going to hear no end of that for the next month, most likely. There's going to be a lot of back and forth. There's going to be a lot of spokespersons coming out and trying to explain why people don't understand this and people don't understand that, and this court doesn't understand this and this person doesn't understand that. And I've always kind of leaned into the idea that if you have to give a really long-winded explanation on why something makes sense, it probably just doesn't actually make sense. There's going to be a lot of that, a lot of negotiating and fighting back and forth on what fits what definition of an emergency. But from an investor standpoint, there's not enough concrete information to even begin to make a decision on the 2-year, 3-year, 4-year outlook of your portfolio, because this changes day to day, week to week. We don't know what the landscape's going to be. So as an investor, hang tight, allow us to weed through all the headlines and read the articles. And if anything needs to change, we'll let you know. But in the time being, we're sitting tight.
Likely tariffs will be on our conversation topics next month. So
Probably.
It'll be just an ongoing saga of how those continue to unfold and if there's actual impact to clients in the markets.
Right.
And that's what our team is deployed to do is to assess those situations and work proactively on behalf of our clients. Big headline from the last month has been related to GDP, and it's a second estimate that's coming out as a decreased GDP number, but it actually may look better than what the original first estimate was. So it's coming in at 0.2. Talk us through the reason for that rating and what the outlook is related to that.
Yeah, absolutely. As the GDP numbers get solidified, they come out in 3 phases of estimates. So the first estimate last month, second estimate just came out earlier today. And the second estimate, as you said, it came in at a negative 0.2, but that was actually a revision up from the negative 0.3 of last month. So negative, but maybe not as bad as people were afraid of. There's the potential that things aren't as bad as was initially worried. But to be in even close to the 0 to negative range is not a great GDP number that we want to see. So by no means is this, all right, that was a close one, let's move on, everything's great. This is not a broad scale outstanding GDP number. To see 2 quarters of this is what people would consider a by the book recession. So we'll hope to see that revise even higher by next month and then see some progress the quarter after to get good numbers going again. A lot of what it's coming from is going to be based off of the tariff outlook. There's potential inflationary aspects, whether that's through maybe a one-time price hike in prices due to supply chain. The big headline over the last month, the back and forth between Trump and Walmart, where Walmart was saying on their earnings call, like, hey guys, if it costs more for us, it's going to cost more for you. Walmart's, I think it's a 2.4 average margin on their products. They can't eat a 10% tariff. So the conversation of what's going to happen to the consumer, what's going to happen to businesses based off of these tariffs, based off the economic conditions, that's the type of stuff that's bringing these estimates down and is going to start showing up in the hard data, because if it costs more for a producer, it's going to cost more for a consumer, and those costs are not always going to be a good thing.
Right.
That can pull down the GDP.
And we'll look forward that third estimate to come out June 26th. So next month we'll be reporting on that final estimate for the quarter. You alluded to this a little, but ultimately we talk about this quite a bit, where your investors aren't just investing in the stock market, they're investing in companies. And so when we look at, all right, what from the last quarter, let's talk about earnings. How did those companies do? How did they respond in the markets? Talk to us about the earnings reports from the last quarter and in the last month for our investors, because they're invested in companies, not just in the market.
A lot of people coming into this quarter of earnings were feeling a little anxious about it. What were the numbers going to be? Was everybody going to pull guidance? How are the companies going to be dealing with the current environment? And for all intents and purposes, it was a good earnings season. And a lot of people are saying that kind of the earnings saved the market. Despite all the headlines, the market was solid. The companies did well. 78% of them, I've got the fact set earnings insight here. 78% beat earnings, or had an earnings surprise, so beat their estimate, that's a good number. I believe that's over the historic 5-year average. That is sort of at odds with what maybe people expected. They were expecting these companies to suffer due to tariff, economy, etc. And so for the companies to remain solid through this first quarter, I think was a really good thing. Hopefully that can continue into this next quarter. But at this point, revenue and earnings did pretty well this quarter.
Another thing that has an impact on companies is lending rates. And the Federal Open Market Committee met last month in the middle of May and remained at their rate, hoping to help bring down the inflationary metrics. From the outlook, looks like they're likely will hold again. Of course, that's a moving target based on a lot of factors. Talk a little bit about lending rates and why that decision was made to stay, and the potential outlook for investors, markets, and the companies that are leveraging lending to grow their businesses.
Right. So the Fed, their dual mandate that they've been given is to try and keep inflation low and to maximize employment. Right now, both of those metrics are sitting pretty healthy. Inflation expectations maybe are etching higher, but the actual hard number of where inflation is at year over year is really quite healthy. Unemployment as well is historically quite low. So they're looking at it and saying, I don't know that we need to do anything right now. And there's a lot of other unknowns that could impact these things that the tariffs could have. Inflationary pressure, again, through the one-time price hikes or through supply chain disruption. And that can come into effect with these dual mandates given to the Fed. A lot of people would argue that they've cut in the past when inflation was higher than it is currently. Why aren't they cutting now? And I do think that the fact that there are so many other external unknowns that they also can't control, waiting sort of pending resolution, I don't expect that they'll be making moves before other things resolve. So I think they will probably continue to hold tight. That's what the numbers are estimated to be, that they aren't really expected to move in the near future. We'll see how headlines and other drivers affect that, but in the near term, they seem very content to sit tight where they're at.
The CME FedWatch tool has them at a 97.9% likelihood that they'll remain at the rate that they're at for their June 18 meeting upcoming. Of course, that's a moving target, and those projections are constantly on the move as well. So that's as of May 29 today. There's a lot of headlines. It feels like there's a lot going on. Of course, the market in April was a wild ride that we talked about. But looking back over a general performance in the market related to May, it feels like it recalibrated. Finishing that April ride and watching the markets in May, what transpired?
As you said, really since that bottom of the market after the tariff announcement, and that spiked down pretty hard, and then when they were lifted, it began to go up again. It's been pretty stable growth since then. It reiterates this idea that historically, the worst days in the market and the best days in the market are grouped very closely together. And so it's important to stay invested, stay with your plan. Also, sometimes stop looking at the headlines as much, because if you didn't look at anything from January 1st till today, the market's just about flat. You could have avoided all the ups and downs and headaches and stresses. And that's not always the case, obviously. Sometimes if you zone everything out, you're going to miss some pretty significant moves in your portfolio that you might want to know about. Not that you need to move, but you just might want to know. So not actually advocating for ignoring everything, but anecdotally, it makes a lot of sense to tune out some of the excess and allow people that you work with, whether it's your advisor, whether it's us, to be the ones weeding through all the headlines and the noise and the data to build the story.
Well, it feels like there's a lot transpiring and taking place that are factors for the market. Nobody is writing an article specifically about your investor portfolio. And I think that's something that you hit on, because investors need to look at their specific situation and their specific portfolio makeup and make decisions that are best for them, regardless of what the market is doing. What's your outlook for clients looking to the month of June as we wrap up May here, Joey?
Like you said earlier, where we invest in companies, not the market, in the same way, each investor is not the market. And so as you're watching headlines, listening to the news, whatever, people aren't talking about your specific portfolio. So don't make decisions based off what they're saying about something that's different. So talk with your advisors, look at your own accounts and see how you're performing, how is it working with your financial plan. And then looking forward into June, keep sticking with your long-term plan and enjoy your summer. Maybe go outside a little bit and get away from all the noise and try and enjoy the beautiful weather.
Heading into June, do you have any wisdom for us?
Wisdom for June, I would say continue to stay invested. We've seen throughout this quarter up until this point in the year, there is a lot of volatility that in the moment we have no idea where it's going to go. And so trying to time the market, trying to get in and out is a really good way to not know what you're doing and to not follow a plan. And then that can have long-term effect on your goals and what you're trying to do. So working with an advisor, having a set plan that you are disciplined and not deviating from is very important. So the wisdom would be, if you're at this point in your investment journey, short-term, nothing needs to change. And so don't make short-term decisions based off headlines, because the whole point of a long-term vision is not needing to do anything short-term.
Right. Thanks for your time today, Joey. wrapping up today our conversation from May and looking into June, if there's anything we discussed today, I know we hit on Moody's ratings, tariffs, GDP, earnings. All of that information can be found in our show notes and disclosure. So if there's anything there that you want to learn about further or dig further into the article, make sure you check out those links below. Thanks for your time today, Joey. Appreciate it.
That concludes this month's LVZ Market Minutes. Quick, clear, and curated to keep you informed and empowered. If you found these insights valuable, be certain to tune in each month for a strategic update. Until then, stay informed, stay invested, and have peace of mind that our team is actively monitoring the markets and managing your portfolios.